Hello everyone, my name is Reese, and in this video I will be kicking off a new series called Should You Buy It? And this series will be looking into different ETFs or stocks over time to dig through some of the financials, what the dividends are like, what index the ETF might track, what sort of fees are taken into account, basically what kind of investment strategy does this whatever fund or company that we are talking about in the video is more focused for, as well as some of the pros and cons that might come into play when investing in that fund. So to start this off, the kick off the series, I will be looking into the Schwab US Dividend Equity ETF. The ticker is SCHD. And what this fund is it's an ETF that tracks the performance of the Dow Dividends 100 index. And what that is the Dow Dividend Index is a composition of 100 US based companies that have a history of paying out dividends consecutively for 10 years. And within that, it also basically it's screening all US based companies that have paid out a dividend of at least 10 years. They are worth at least $500 million in market cap. And then they get that huge list of whatever companies have paid out that dividends for 10 years. And then they start digging through using fundamental screens to look at cash flow, debt ratios, return on equity, dividend yield, and dividend growth to help filter through and see what those best performers are. And after those screens are put into place, they're looking for some quality, financially strong companies that are paying out dividends consistently with growing profits. And this is something I've talked about before is typically companies that have high dividend yields, usually the higher the yield, usually the less growth that the company may experience or may have to cut that dividend. So when you're looking at companies, you really don't want to just chase for high dividends. You want to know what their cash flows are like, what their debts are like, what their price to earnings are, if their dividend is actually growing. And these are things that the Dow Jones US Dividend 100 Index is already taking into account for you. And so what it does is after it uses all those filters and finds 100 companies that fits those criteria, it then builds a fund. And within this ETF, no one company can be worth more than 4% of the fund. Now, this is rebalanced quarterly. So between rebalancing, a company may stray to be worth more than 4% temporarily. But then when the ETF is rebalanced, it'll go back down to 4%. So this kind of helps you limiting any one particular company becoming a dominant role in the fund. For example, if you look at QQQ, their top 10 holdings were, I believe it was like 65% or something at one point. So basically, the entire fund was getting dominated by just a handful of companies, whereas this index is trying to help diversify that. So that is what this ETF is tracking, the Dow Dividends 100 index. And then looking into of the ETF. So the Schwab US Dividend Equity ETF has an expense ratio of 0.06%. So overall, that is a very solid expense ratio, especially for the family of dividend ETFs. Usually Vanguards are going to have the absolute lowest expense ratios on average, but the SCHD is the only Dow Dividends 100 index fund at this time. And then looking into a little bit more, so as of right now, the current price is 75.81, and then it has a pretty good volume. It's easily tradable in and out, so it's liquid. You're able to move money in and out of it. It's got a low expense ratio, and then let me believe it's as of right now, it's paying a 3.38% dividend yield. So that is a pretty nice yield. As of right now, that is double what the S&P 500 is. And going into morningstar.com, which is a pretty nice way that you can use to help kind of dig through the fund a little bit. If we go on Morningstar for SCHD and we go to the portfolio tab, we will see that this is a value-based fund, because typically any dividend paying companies are usually going to be more value based, especially with those strong cash flow dividend growth screens that were used to pick the companies. That is going to give you more large cap value plays. And going back to the fund, if we go down to portfolio, some of the top holdings right now, and this is, remember what I said, typically it tries to keep everything under 4%. Between rebalancing periods, it may stray beyond 4%, but after it's rebalanced, it'll go below that. So top holdings as of right now are Amgen, Merck & Co., IBM, Pepsi, Lockheed Martin, Pfizer, Texas Instrument, Cisco, Home Depot, and Coca-Cola. So these are companies that have a history of strong financials. They're predicted to increase their dividends, or a history of growing their dividends. So it's going to, as of right now, the largest portfolio percentage is information technology, with financials, consumer staples, healthcare, industrials. Energy is towards the bottom, and historically, energy usually does pay out high dividends. The problem with energy companies, though, is that they may not have a strong history of growing dividends, strong debt ratios. So something like Coca-Cola and Pepsi may be in better financial situations. Home Depot is another very strong company financially. So you can go through the list here if you really wanted to go through all of the holdings just to kind of see. But basically, these are going to be, SCHD is going to hold large cap value companies that pay above average dividends with good dividend history. Looking into Seeking Alpha has a pretty nice tool that you can use under the dividend tab to see dividend yield over time. And what's nice about SCHD is that it incorporates not only high dividends, but growing dividends. So if we go down to the yield on cost, this is what your yield, your dividend yield would have been if you had bought at any particular time period. So what I mean by that, if you buy this dividend today, or this fund today, you're going to get about 3.36% annual dividend. Now, if you had purchased this 11 years ago, your dividend yield on cost would be 9.75%. So what that means is if you had bought this 11 years ago, because these dividends are growing, as you hold the fund longer, the dividends are increased, so your initial position that you have is giving you more and more dividends. What I mean by that is, let's say you buy a stock for $100 and it's paying a 5% dividend yield, so $5 per year. Every year, that company increases their dividend by $1. And you hold it for 5 years. So you initially bought a stock for $100, paying out a $5 annual dividend. You hold the stock for 5 years, and it increases the dividend by $1 a year. So at the end of 5 years, your $5 dividend payments are now $10 per year. So you are getting 10% returns per year on your initial investment on dividends alone. So this really is going to fuel compounding growth, especially if you are reinvesting those dividends and you have a long time horizon. You will see initial positions starting to get some pretty hefty dividend yields over time. And the reason for that is because this index is tracking high dividend and growing dividends at the same fund. So it's a kind of a blend of both worlds. Some comparison funds would include VYM, Vanguard High Dividend Yield, and then VIG, Vanguard Dividend Growth. So it's kind of a blend of both, to where you're getting growing dividends and high dividends all in one. So we went through what the fund tracks, what the positions are, and then what the fees are. Good dividends, growing dividends. What kind of investor is SCHD going to be good for? So at the end of the day, another good thing that's good about SCHD is that it has strong capital growth. So because it is 100% stocks and it's investing in quality stocks, in the past 10 years, it's actually returned an average of 13.4%. So it is keeping up with the S&P 500 pretty closely. In fact, if I pull up TradingView, pull it up real quick. So SCHD, I'll get rid of these filters real quick. So let's compare SCHD with the S&P 500 and adjusted for dividends. So with reinvested dividends, SCHD is holding its ground very well with the overall market. And we got to remember, SCHD is not including these growth companies like Apple, Amazon, Tesla, all these big name companies. It's holding financially strong companies, and they are really holding their ground. And where SCHD and dividend funds are really going to shine is in downturns. With reinvested dividends year to date, we are experiencing a down market. So the S&P 500, if you had been reinvesting your dividends, you would be at a minus 16.45% return. With SCHD, you are only down minus 2.62%. We take out dividends and still minus 5%, minus 17%. So what this is showing is that these dividends are not even without the dividends alone. These value-based companies are holding their ground during downturns because they are stronger financially secure companies overall. So by including SCHD in your portfolio, you are basically hedging in a downturn by focusing on more value plays. Even if you're not investing in some high growth companies, you're investing in quality companies. So I think SCHD realistically would be good to as a complement to a core holding. I don't really think that SCHD should be a core holding, especially if you have a long-term time horizon. What I mean by that is I'm in my 20s, for example, and if I was thinking about buying SCHD in my IRA, for example, which I know I have a 40-year time horizon on it, I'm going to be I personally am more willing to include some growth stocks with that long time horizon. So I'm going to be looking into maybe an S&P 500 or total market as my core holding. However, complementing it with a dividend fund, I think is a great idea as well, especially if you want to start getting those dividends early. Because if you think about it, if I'm in 10 years, if an SCHD original position is already at 9.4%, if that growth continues, think about how many dividends you could get over the lifetime of 40, 30, whatever it is. Because especially when you're getting into retirement age, having strong dividend paying companies can really be a nice way to complement your portfolio. Because if you can live off dividends alone without having to worry about selling your shares, that is a great position to be in. So I personally do have SCHD in both a personal brokerage account and in my retirement Roth IRA. So I think it's nice because it has lower volatility compared to the S&P 500, which is including these growth stocks, but it's investing in quality growing companies as well by including dividend companies with a history of growing their dividends. So I think it's bad to be I don't think it's the best fit for a core holding, meaning the largest percentage of your portfolio. But I do think it would be a good complement for whatever percentage you see fit to meet your goals. So I hope all that made sense. Hope you guys enjoyed. I hope to keep this series rolling in the future with starting with some other popular ETFs and then slowly moving on to individual companies as I get through the list. Hope you guys enjoyed. If you have any content or feedback or suggestions, feel free to leave a like, comment, and subscribe if you want to see more content. I really appreciate all the views, and it helps keep this channel going. So thanks for watching, guys. Hope you have a great one. Peace out.